Thank you very much for joining us on today's webinar. It's Chris Thomas here. I'm a director of One Accounting, and I'm speaking to you live from Edinburgh, and it's a horrific day. For any of those you listening in Scotland, you'll know what I mean. The rain is lashing against the window, so if you hear some background noise, that's what it is. What we're going to do today, we're going to have a quick 30-minute webinar to look at the budget summary from yesterday and how that actually affects SMEs, and also run through some ways that you can actually reduce your personal tax liability for this tax year end and also for future tax years as well. We've got a range of people on the webinar today, young and old, business owners and non-business owners, high earners, low earners, a real wide range of people. So hopefully there's something in here for everyone. Okay, firstly, as a way of introduction, it's just a quick introduction to our team. There's 9 of us at One Accounting. We always have a celebratory breakfast every February. As you may know, accountants are very, very busy in December and January with tax returns. So this is a picture of our gang having a well-earned breakfast on I think it was the first Monday in February. And I'm the guy at the front left, if you don't actually know who I am. Our bread and butter is actually to provide annual accounts, tax, personal tax, business tax, payroll, VAT and management accounts to a range of clients across Edinburgh and the Lothians. We also have clients across Scotland and some in England as well. We're big fans of technology to help make our clients' lives easier, and 2 great systems that we use are called Xero and Free Agent. So all of our team are fully expert in those. We're based in the Dean Village in Edinburgh. We've got a really interesting building here. It's 140 years old, and we could possibly be the only accounting firm in Britain, I would say, with a balcony and a turret around the back. So next time you're passing, do pop in and we can show you the view of the Dean Village from the balcony. Okay, so firstly let's run through the budget summary. It's quite a nice quote there from George: if you're a maker, a doer or a saver, this budget is for you. And I'm not sure whether George is living in a parallel universe or not, but it's true to say that there's not too much that he had to play with in this budget. So perhaps the most interesting thing for a lot of people was the announcement that we're going to have a new £1 coin from 2017. So it's 12-sided, and it's really designed to guard against counterfeiting. So I heard something on the news saying that 3% of all of the £1 coins in the UK in circulation are counterfeit, and the thought is that they can actually make the counterfeiters' lives harder through this new 12-sided coin. So the key points of the budget, there was very little change for SMEs in the budget. There's a couple of reasons for that. The first one is that there's a general election next year, and what chancellors tend to do in the year before an election is just play things safe and really introduce a couple of vote winners, really to sow the seeds in people's minds about how they might want to vote next year. So the 2 things that he has done there are to make big changes on how people can actually take their personal pensions in the future. We'll have got a couple of slides on that in a minute. And also a big increase in the amounts that people can actually put into ISAs, so it's definitely a budget for savers as well. Another reason why Mr. Osborne couldn't really do much in terms of giveaways is because of this. The government this year will spend £95 billion more than it actually collects in taxes, which is quite an alarming figure. You'll see from there on the graph, the red line is Mr. Osborne's prediction of how the deficit will actually reduce. So we're sitting just below 100 billion of extra spend this year, and you'll see that that will come down, and his prediction is that by 2018 we're actually going to have a budget surplus as well. Okay, let's just rattle through some of the key points on the main taxes. So on income tax, the main rates are staying the same, which is 20%, 40% or 45%. The tax-free allowance for everyone in the UK will go up to £10,000 from the 6th of April this year. So what it will mean for those of you that have employees, they're going to receive about an extra £10 a month in their salaries each month because of the increase in the tax-free allowance. And he's announced that it's going to go up by an extra £500 from next year as well to £10,500. For those of you who are directors of your own limited company and are using the most tax-efficient mechanism to pay yourself, currently you're paying, I think it's £641 a month, which is the tax and NIC minimum. That will increase to £663 a month, or just under £8,000 a year from this April. So for those of you that are on the call of the clients and we actually run your monthly payroll, there'll be some communications coming out just on these changes in the next week or so. There's a little bit about what we call the squeezed middle, which is, I think various newspapers refer to anyone that's a 40% taxpayer as the squeezed middle. So I just actually did a bit of research before the call, and only 15% of the UK population are 40% taxpayers. So only 15%, which is about 4.5 million people, are earning over £41,865. Mr. Osborne's announced that this banding, this limit, will go up by a measly 1% next year. But I think it's important to stress here that 85% of the UK population are basic rate taxpayers and aren't affected by any movement in the 40% tax limits. On to corporation tax, no changes in the tax rate, still stays at 20% for small companies. For those of you that are investing in plant and equipment, the annual investment allowance has doubled to $500,000 until the end of next year. But this really is only for big companies that are investing substantial amounts in plant and equipment and premises that this is actually going to benefit. Okay, this is probably the biggie, I think, on how people on the call are going to be affected. So this change has actually been announced, but I'm just going to go over it again. So there's a £2,000 employment allowance which will be introduced from next month. So what this means is that any employers who currently pay a total of £22,000 in salaries to all staff will reduce their employer's national insurance bill by £2,000 per annum. So there's £2,000, which is the maximum amount. It's per employer, so it doesn't matter how many employees you've got, it's just for the employer. And currently, those of you that have employees are paying 13.8% employers' national insurance. And the actual saving there is that the £2,000 is effectively given back to you by reducing your monthly pay-as-you-earn bill, the pay-as-you-earn and national insurance payment you make around the 22nd of the month. So the good news is, for any clients on the call, we claim this for you, so there's nothing you need to do. You'll see this through having a reduced amount of national insurance to pay, certainly in the early months of the tax year as well. Another small change is that anybody that's self-employed, the Class 2 national insurance, which is the £2.70 a week that you pay in national insurance contributions, that's going to be merged into the self-assessment regime from 2016, so you'll no longer have to pay that extra amount. Great news if you're a saver. The annual ISA allowance has actually increased from $11,500 to $15,000. Strangely enough, from the 1st of July. Normally, changes in tax rates and savings rates kick in from the 6th of April, but this one is coming in from the 1st of July. What it means is that you can put £15,000 into an ISA, and another change is previously you could only save a maximum in cash of $5,760. You could save another $5,760 into stocks and shares, but you can put, like I say, a maximum of $15,000 in. So this is a sort of big change for people that are lucky enough to have substantial amounts of savings. For those of you with children, you can set up a junior ISA for your children, and you could put in up to £4,000 a year. Another new announcement was that there's going to be a pension bond introduced for over 65, which is basically meaning pensioners can lend money to the government, I think it is. So you invest in a government bond, give money to the government, and you will receive between 2.8% and 4% interest, depending on how long you put that away. So great news if you're a saver. Pensions, I think there's going to be a lot of fallout over this. It's the biggest shake-up for a century. What it means is now that when you come to retirement age, you get as much choice as you want about what you do with your pension pot. So I heard somebody on the radio today that asked an expert whether they could just reach the age of retirement, take all of the money out of their pension fund and go and blow it on a holiday or a space travel trip with Virgin Atlantic or whatever they're called. And the answer is yes. So it's quite scary actually. So before you had to normally you could take an amount cash free and then buy an annuity or an income stream with the balance, but the new rules are that you can do what you like with it. And I know that shares in insurance companies and investment firms actually fell on announcement of this rules. So I think there'll be quite a lot of, like I say, commentary on this. I'm not really sure which way this is going to go, but it's certainly a big shake-up. Another one for those of you with children, this is very interesting. So again, this is an update on a previous announcement. From autumn next year, you can claim tax relief of 20% on your childcare costs up to £10,000 per child, as long as the child is under 12. So this really replaces the current childcare voucher scheme. So at the moment you can claim tax relief on £55 a week, so there's actually a big change as well. And currently the childcare voucher scheme isn't available to the self-employed, and also if you, anybody out there that doesn't have an employer that supports the childcare voucher scheme can't actually claim this tax benefit. So it's a lot simpler. It's claimed by the parent and through an online form, not by the employer. So they reckon the amount of people who are going to benefit from this will actually double. So I think that's a really good thing. Okay, that's a quick run through of the key points of yesterday's budget. And now we'll just move on to 10 ways to reduce your personal tax liability. So again, just to stress that we've got a mix of people on the call today, and hopefully some of these will apply to you and your circumstances, but I can't guarantee it. So let's roll on through. Okay. The first thing that you should do is check your tax code. So there's 25 million tax coding notices that are sent out every year by HMRC. These still come through the post. Eventually they will come online to taxpayers. And as you'd expect, with 25 million tax codes, some are wrong. So we've had phases, I think it was in 2011, they estimated there were about 2 million tax codes that were incorrect, mainly due to HMRC system faults, but it's quite alarming in the number of clients and other people that come to us because there's just a historical error on their tax code. So what you need to do, you can find your tax code on a payslip, a pay-as-you-earn coding notice, P45 as well, and the standard code for the current tax year that we're in is 944L. So if you haven't got 944 on your payslip, etc., then there's one of two reasons. So if it's lower than 944, you're paying extra tax at source to HMRC. So it may be that you have a benefit in kind, such as a company car. It may be that you owe tax from a previous year, or it just may be incorrect. If it's higher than 944, what it means is you're getting extra allowances. This may be because you're claiming, say, tax relief on a pension, or you have a professional subscription that you're entitled to tax relief on. So again, if it's higher, you should always check that as well, because we probably see an equal amount. So some of the low ones are wrong and some of the high ones are wrong as well. So you shouldn't just assume because you get a letter from the taxman that it's actually correct. So you should definitely check that. What we can also do there, for those of you that have employees, we're very happy to check their tax coding notices as well. So it applies to clients and also people that have staff. We're very happy just to have a look over the tax coding notice as well. Okay, the second tip is to look at a uniform allowance. So this is actually a very little known area of tax. So some workers can actually claim an allowance against tax. HMRC describe it as the cost of washing uniforms or protective clothing. So this is really to cover the cost of your personal automatic. So if you think about it, I've put a few trades on there as well, joiners, plumbers, chefs, etc. So you think, yeah, these people are actually working in, you get fairly grubby doing these jobs, so it's the taxman's way of just making available an extra allowance for you to claim that. Anywhere where it has to wear a uniform through work as well, so I put down the police, fire brigade, pilots, etc. And a lot of people involved in the healthcare business, that might be the NHS or private healthcare as well, can claim this allowance as well. Unfortunately, if you don't need specific clothes or a uniform, then it's unlikely that you can claim this allowance. So myself, sitting in my suit here today, I can't claim it. If you're a techie that wears jeans and a check shirt to work, I'm afraid you can't claim that either. But there are a couple of links here where you can see a full list of industries, which is the HMRC link. And also, there's a really good website called Money Saving Expert as well, and they've got a really good article about the uniform allowance and how you can actually go about claiming a tax rebate as well. So those links are definitely worth following. For those of you that might be furiously writing down that link, the webinar is going to be available on YouTube later on today as well, and you're also very welcome to email me, which is chris.thomas@oneaccounting.co.uk, and I'll be more than happy to send out these slides so you can have that link as well. Okay, the third tip is keep your child benefit. So again, this affects children and it affects high earners as well. So this was a change in the rules which came in last year. So any household with an earner, a person who has more than £50,000 of income, will start to lose some child benefit. And once the highest earner in the household gets above 60K, then they lose the child benefit altogether. So for those of you with reasonably large families, this can have quite an impact on your household budget. It's important to stress that the income includes a variety of things such as your salary, any dividends that you get either from your company or other shares, bank interest, and benefits such as the company car and P11D. And to keep the child benefit, you need to get your taxable income below the 50K. So I've just put some little pointers on there on how you can actually do that. If you put money into a company pension scheme which comes out of your salary, then that will reduce your taxable income. You can buy childcare vouchers as well through your employer. One or two people work for employers that can actually buy extra holidays. So I've seen this happen where people, they get the option to maybe buy an extra 3 or 5 days holiday. It's a form of salary sacrifice, so this gets them below the income level that they want. You can also give money to charity. We're going to cover gift aid in a few minutes, but that's another way of doing it. We've got a slide in a minute on income shifting. So for those of you that actually run your own business or are directors of your own business and have a little bit of choice about how you actually get paid, then it is possible to actually shift income from yourself to your spouse, and we're just going to cover that in a minute, so that's probably worth considering as well. Okay, the tax system is actually really, really complex. So tip 4 is called watch out for income tax at marginal rates. So I've put a little table on the screen here. Now, most of you might just think that there's just a couple of tax rates, which, okay, we know we get 9,500 each year tax-free, then there's a 20% bracket, a 40% tax bracket if you're in the top 15% of earners. If you're a super-duper earner, then and you earn more than 150,000, then you pay tax of 45%. But there's actually more. Hopefully you can see my little cursor buzzing around here. So the 9440, you pay no tax. The rate at which you pay 20% tax is 41,500 there. And then there are some new sort of hybrid rates which are affected by really the child benefit rules is the first one. So if you're between 41.5 and then 50, you'll still pay tax of 40%, but when you get to 50,000, as I put on the previous slide, you will start to lose some of your tax, your child benefit. So what this means is the more that you earn, the less income you have. So it's almost like the loss of child benefit is an extra form of tax. So in some cases, depending on how many children you have, that can be, you've got a marginal tax rate there of sort of 60 to 70%, which is the 40% plus the loss of the child benefit. Once you get above 60,000, okay, the tax rate is 40%, but at that point you've lost all of your child benefit. Again, if you're a high earner and you earn above 100,000, what happens there is that you start to lose the tax-free personal allowance between 100 and 119K. So you've got an effective tax rate there of 60%. And then once you get above 118, it goes back down to 40, and above 150, it goes to 45%. So again, that's a really quick slide. So if there's any people on the call that need just further clarification of that and which tax bracket they're actually in and how it affects them, again, you're very welcome to get in touch with us and we can explain that. Okay, tip 5 is called income shifting to your spouse. If your income is on or around one of the marginal rate brackets, so it's really any income level on this screen. So if you're getting close to the rate at which it changes, you maybe consider transferring some income to your spouse. So there's a few ways that you can do that. The first thing is to look at assets that you own. So this might be cash that you earn interest on. It might be, say, a rental property that you own maybe individually or currently with your spouse, or it might be actual shares that you own, including shares in your own company. So you can actually, between husband and wife, wife and husband, you can make the transfer of assets without any tax penalty. So it's possible if you own shares in your own company to gift some of these to your spouse. And the advantage of that is that if you're currently receiving dividends, then the level of dividends that you receive will go down and the amount of dividends that your spouse will receive will go up. And this is a tactic you can employ to get, say, below the 41,500 rate at which the 40% tax rate kicks in, or in some cases it may be that you can use this to get back under the 50K limit for child benefit as well. And another consideration is if you have a non-working spouse, you could consider employing them in the business, but the rules on this are fairly strict. And certainly my experience from sitting in HMRC inquiries and visits, if there is a spouse on the payroll, then certainly the HMRC inspector will want to find out a little bit more and find out what that person does. So there needs to be a genuine role that that person fulfills in the business, whether it's bookkeeping or admin, diary management, that sort of thing. So that's income shifting. Okay, on to tip number 6, which is called fees and subscriptions. So if you are a member of a professional body or society or a union, then it's possible that the amount that you pay personally in fees or subscriptions will be available to claim a tax allowance. So for example, I'm an accountant, I'm a member of the Chartered Institute of Management Accountants. I pay my subscription each year because I need to do that as part of my job, and I can actually claim tax relief on the amount that I pay. If anybody involved in the healthcare business or the trades, you'll generally find that a lot of people here will be the members of a union. Again, in some cases all of the union fee is you can claim tax relief on, and in others it will be a percentage of the union fees as well. And you can actually go back up to 4 years to claim this amount as well. So again, I'll put a link on there to an HMRC page which will actually list out the professional bodies that you can claim for, as it were. So it's not the best screen. There's no search facility on there. It's basically looking up alphabetically and running through a big long list. But it's worth checking as well because you can go up to claim back up to 4 years on this. Okay. On to tip number 7, which is tax-efficient savings. So I covered earlier on in the presentation the increase in the ISA limits. Again, this is just worth looking at as we come towards the end of the tax year to see if there's any more monies that you can actually put into your ISA, if you, or maybe set up an ISA if you don't have one as yet. Again, just anecdotally, what I can advise in terms of clients that actually put money into ISAs, what we find is that they actually lock money away. So they have savings there, and they do put it into an ISA. Some people lock it away for sort of a 2 or 3 year fixed term, and generally they don't touch it. So if you're the sort of person that has savings that maybe dips into them from now and again, then maybe an ISA will encourage you to put money away for the long term. So the limits at the moment are £5,760 in cash and the same amount of stocks and shares. But as I've noted before, this is actually going up to £15,000 from the 1st of July 2014. The ISA rates aren't great at the moment. Again, I just did a quick search online. So if you want to put money away for sort of 3, 4, 5 years, you can get 2.5%. If you just want a general one that you can get sort of fairly immediate access to, then it's 2%. So they're not great. But again, I come back to the fact if you get into the regular habit of saving, then over a number of years you can actually build up a really decent amount. Okay, tip 8 is tax-efficient investment. So this is really for the long term. This isn't necessarily something that you have to do before the 5th of April. What you can do is claim tax relief by investing your own money, so it's your own money rather than the company's money, into shares in, I just describe them as new start companies. There are 2 schemes, the EIS, which is Enterprise Investment Scheme, and the SEIS, which is the Seed Enterprise Investment Scheme. So the basic way that it works, in the EIS, say for example you invest £10,000 in shares in a qualified company, you'll get £3,000 off your tax bill. If you did this under the SEIS, now generally the companies that you invest in the SEIS are smaller and therefore they're perhaps riskier, you get 50% tax relief. So you put in 10,000 and you get £5,000 off your tax bill. Another attractive thing is that you can actually carry this back to a prior year. So we have some clients that are looking to make investments into one of these schemes, say this summer, and what it's actually going to do is reduce their tax bill for the current year that we're in. So they'll make the investment, say, in July, but we can backdate it as if the investment had actually been made, say, at the end of March in the current tax year as well. So you can carry backs. So it's something you can maybe look at in the future. And also it's a way of saving capital gains tax. If you actually, say, for example, sell shares and make a profit on those shares, if you put the money that you've gained into either EIS or SEIS, you can claim tax relief on that as well. So again, the best thing to do here, if you're thinking about making an investment, then please do give us a call and we can talk through the basics of it because it's important how you understand how these things work. So that's tip number 8. Tip number 9, again, is planning for the long term, and this really only really applies to higher rate taxpayers, so anybody in the 40% rate or higher. Currently, if you personally make a payment into a personal pension plan, HMRC will top this up by 20%. So for every £80 that you put in, HMRC will put £20 into the fund. Anybody in the 40% tax bracket that is making contributions can claim a further 20, well, I put £20 there, that should be, well, it's 20%, yeah. So you can then claim an extra £20 tax on the example that I've given you. And this puts money into your pocket, so it doesn't actually put money into the pension fund, it gives it back to you, and you can either claim this through your self-assessment return or by calling HMRC. They'll actually make the adjustment if you speak to them over the phone. And another key thing as well, if you've not done this, we occasionally get 1 or 2 clients that forget that they've actually made pension contributions. It does happen. You can backdate it by up to 3 years as well, so that's a nice little bonus that we've had 1 or 2 people get. The very last tip for today is to claim gift aid on charity donations. Again, this benefit really will apply to higher rate taxpayers only. So what this means is that, say for every £100 you donate to a charity, if you're a higher rate taxpayer, you can claim effectively £20 tax back through self-assessment. What we found here that record keeping is absolutely, it's key, it's paramount. Again, you can make donations through a variety of channels these days. You can sponsor people to run marathons through sort of Just Giving and Virgin Giving. Some people donate to a church. Some people will sponsor their friends and neighbours to do things, and you sign a form. So the record keeping as part of this is really, really essential, because again, if HMRC at some point in the future want to make an inquiry into your tax return, you need to have the evidence that you've actually made the donation as well. But again, charity donations have obviously a wider impact to society, and I think it's great that you can get tax relief on them as well. Okay, we're just approaching the end of our half hour here, so it's a quick rattle through some tax tips that you've got there. What I would say, if there's any sort of clarification you need on the budget or any of the tips that I've gone through today, or indeed if there's anything that you think we've missed in terms of sort of golden nuggets that you think could be a benefit to you, then please, by all means, do get in touch with us. Okay, just before we sign off, to all of our clients, we're going to be emailing a 2014 budget summary, which gives you chapter and verse on the budget, and that's going to be coming out later today. Again, for clients, there's a new thing that we're launching called Business Bite Size. This will come out in early April, so it'll be an email report, and it's really, I'd call it a book summary. So what we're going to do every 2 months is summarize the key points from a leading business book. And this could be on business improvement, it could be on marketing, it could be on managing staff, a whole range of things. So what we've got there is really a bite-sized report that you can put the kettle on and read, and hopefully get some like I say, some key pointers on how you can improve the running of your business as well. And the final thing is that we've moved with the times. We have a YouTube channel as well. So if you'd like to rewatch this webinar presentation, or maybe share it with a friend or a colleague, you can watch it on our YouTube channel, and this will be going up later on today. And we're just building up a little library there. So there's some webinars there on VAT and basic bookkeeping, and also some hints and tips on zero and free agent as well. So again, if you've got an idle few minutes, please do check out our YouTube channel as well. Okay, well, I think I am at, there you go, 10:58, so I've beaten my deadline by 2 minutes. So it's been really good having everyone on the call today. I hope you've got some benefits from joining me today. So if you'd like what you've seen, if you need any more advice, then please do contact us. There's a couple of numbers there and contact details via email and Twitter. So it's been great having you. So this is Chris Thomas speaking from a very rainy Edinburgh, and have a good day, and thanks again for joining us. Bye-bye.